Hey everyone, welcome back to economics again. Of course, what else would you be? You're not coming here to hear me talk about anything else. But anyway, welcome back. I hope you enjoyed our last session on economic systems and that maybe you would have had some time to play around with the link that I put on D2L. If you didn't, no worries. It's there strictly for your increased interest if you have any. And otherwise, we will get started on the next section. So in this upcoming session, we're going to talk about profit and things like that eventually at the last part of it. So in there, I include some accounting terms. I don't know if that accounting or not is not a prerequisite for this class. So if you have not, what I do is I include a list I've put on D2L for you to check out. So you can look there and it has definitions of what, and if there's something you have trouble understanding, by all means come and let me know and we'll work on that. Otherwise, just kind of keep on keeping on. But I was doing that to save us some time so we don't have to go through their terms that don't relate necessarily except to this one section. Okay, so let's get started. So the first thing we're going to talk about today is, here we go, trusty whiteboard. Okay, the first thing we're going to talk about is a concept that is very useful for businesses in terms of pricing, and that is elasticity. And elasticity means it is the measure of responsiveness to price. And there are many, many different types of elasticity, but what we're going to talk about today is the elasticity of demand. And that's what we're going to talk about the most, because the others, there's some little other ones, elasticity of supply, elasticity of income, but we're just going to talk about elasticity of demand. And what this does, it measures how much quantity demand changes when there is a change in price. Okay, so how much does quantity demand change when there is a change in price? If it changes a lot, we say a good is elastic. And that is when the change in price has a big effect on quantity. On quantity demand. Okay, that was weird. I guess I hit the wrong button. Okay, on quantity demand. Hopefully it didn't look weird from your side. So if there's a big change, then the good is elastic. So it means if price goes up a significant amount, quite a bit of consumers will no longer buy that product or will stop buying the product. Consequently, if it goes down, the change in price, then that means that a lot of consumers will start buying more. So quantity demand will increase by a large amount. Now, most products fall in this category. Most products are elastic. Now, the opposite, if there's not a big effect at all, then we say a good is inelastic. And inelastic is when the change in price has very little effect on quantity demanded. So an example for that might be, or is necessities, such as medicine. So necessities like medicine, if you need medicine and there's no substitute for it, you have to have it. So whatever the price is, you'll pay it. A couple of years ago, I think it was, the price of EpiPens had raised exponentially. I mean, it was something like, I believe, $300 per EpiPen, if I'm remembering correctly. But if you are someone or you know someone who has these extreme allergies that they're going to die if they don't get the EpiPen, they'll pay the $300. You know, what is your life worth that's worth $300? So therefore, the change in price, the EpiPens had gone up very high in change in price, but it had very little effect on quantity demanded. If you needed it, you bought it. Likewise, if they go down in price, same thing, not a lot of change there. It's not like you can store a lot of these things. You buy it hoping you'll never need to use it. they certainly expire, so you don't want to stock up a bunch of them so that you don't want to stock up a bunch of them so that have them expire on you. That's a waste of money as well. The only thing that happened is you might say, for example, if you have a child who's allergic, the parents may buy a bunch and put one at school, one in their clubs, maybe at a friend's house or a grandparent's or something like that. So you might have them at multiple locations if the price goes down. But otherwise, no, not gonna buy too much. Another example are lower priced goods, such as a container of salt. Salt is very cheap. Buy your basic salt, it's going to be $1 or less a canister, and so let's just say $1. So if salt were to go, let's say if salt increased by 50%, the price increased by 50%, so that gets you to $1.50 for a container of salt, but it's still not a lot. It's not going to rock your world very much. So it's doubtful that you're going to stop buying salt because of that. Now, likewise, if it decreases by 50%, so it's 50 cents a container instead of $1 a container, people aren't going to just stock up on salt because it's not a very big part of their budget, not a big part of their world. So lower priced goods like that, same thing. You're not going to stock up, or nor are you going to stop buying them. They're just not a big, they don't affect your life that much. And the next one is unit elastic. And I don't like this one because when you look for it, you see no notable examples. And I don't like things with no notable examples because then that makes you wonder, is it Bigfoot? Does it even exist? If there aren't any examples of it, why did they even come up with this? But what it is when the change in price has an equal change in quantity demanded. So when there's a change in price, if the price goes up by 10%, that means there would be a 10% drop in quantity demanded, exactly 10%. And that's why it's so hard to figure out. Now so I posed the question to my students over the past years to come up with an example, see what they could come up with. And one especially stands out, so I'm going to share this one with you. I had a student once who came up with an idea. He said, Miss, I think I've got the idea. He said, I think that marijuana is a good example of this. And I said, marijuana? Okay, let's hear more about that one. And he said, well, the reason I say that is because when my customers, and when he said that, I was like, no, let's stop right there. No, we don't want to hear that. You shouldn't be talking about that. And he was going to tell me how his customers, but so we had a nice laugh over that. And he powered on because that's who he was. So anyway, what he came up with, he said that his customers will bring him, they have a budget for marijuana. And I'm incredulous saying this, but they have a budget for marijuana, and their budget say it's $20 a week. So they'll bring him $20 and they'll say, hey, I need $20 worth. And he'll give them whatever his prices are, $20 worth. So he said if his prices go up or down and they still bring the same amount, so there's a change in what they get based on that. And I said, okay, that's close. We're going to just let that one stop right there. So anyway, so that is something that was very, that I always share example with students because it wasn't a half bad example, but it also, we could use a laugh when we're talking about things like that. Okay, so here's an example of elasticity on something that is more to our liking. So an exercise, talking about elasticity, we're going to talk about Netflix. So Netflix, we're going to start our story, our example, in 2011. So Netflix, before that time, they were mainly DVDs, and they just started adding streaming and any widespread uses about then. So streaming plus DVDs. And that was what they had in 2011. Okay, so let's look right here. So in 2011, all right, let me draw a table, and then we'll go back and type the text. And yes, look at my lines. They're so straight and lovely, aren't they? Okay. So what we had there, we'll put the percent price increase right there. And in this column, we're going to put percent loss of customers. Okay, so for 2011, Netflix went from $10 a month to $16 a month. $10 a month to $16 a month. That is a 60% increase in their price. Now that is a lot, isn't it? Again, this is a good example of marketing, of how marketing can be done, because $10 to $6 extra a month for most people for their streaming, it goes up that something goes up $6 a month. You know, just like before with the salt, it's not going to rock your world. You're not going to sit there and say, oh my, if they, you know, if they would have had me at $5 a month, that extra dollar a month just isn't going to, you know, that's not cutting it for me. Perhaps, but nevertheless, that kind of increase is not that much. But we present as saying Netflix went up on their prices by 60%. Well, that sounds just astronomical. And if you don't get the other numbers to go along with it, you may very well stop subscribing to Netflix. So what happened there? Okay, but then looking at the numbers, when people saw it on their bill, what happened there? They had a loss of customers of 1 million. So they lost 1 million customers in 2011 just from that price increase. Now, the reasons may be many things. It may be that, you know, they may have marketed it poorly. It may be, more than likely, what I'm thinking is that at that time, people just didn't get streaming. It wasn't something that was widespread, and a lot of people just didn't care about it that much. So they weren't going to pay extra to get it. So they lost 1 million customers. You would say, therefore, that Netflix at that time was elastic, wasn't it? It was elastic because they had a big jump in price, a big percentage jump in price, and then they had a big percentage loss of customers. All right, now we're going to fast forward here to 2014. And so for 2014, they're starting to cut out their DVDs and just charge for streaming. So they had another price increase at that time. So they went up. It was $8 a month to $10 a month. Now that's barely going to move the needle on somebody's budget, right? $2 a month, nobody's really going to pay attention to that. Even though now the percent change, again, would sound pretty high if it was marketed incorrectly, because it's a 25% increase in price. That sounds like a lot to people. I mean, that would sound like if somebody told me that something I used was going to go 25% in price, and that's all the information I had, I would probably, I mean, I would freak out, you know. I want to know more about that. Probably I wouldn't freak out because I'm an economist, but it would definitely give me pause. As an economist, I would go look and say, all right, how much is that exactly? Okay, so I'm going to let you guess in your mind, since you can't tell me out loud, what was their percent loss of customers? I'll give you a moment to ponder that and to shout it at the screen. 0. See, my dog just contributed. He knows the answer. You knew the answer. You were cheating. 0. They lost 0 customers there. Many reasons why that might be. People were getting into streaming now. A lot of people at 2014, they were starting to let go of their cable, cut the cord, as the marketing campaign said. So they were going strictly to streaming and doing away with, you know, the DVDs were being phased out, and so people were streaming. And it was a very small increase in price, $2, even though it was 25%. So therefore, a lot of people, it was just like in the past when a landline was a necessity and a cell phone was a luxury. And now, of course, that's flip-flopped, and you wonder why people even have a landline. Most people don't anymore. And so things have flipped around. So now streaming is more of a necessity. People are doing without cable. So therefore, you could say that in 2014, Netflix streaming had become inelastic. So that tells you a little bit. It shows you an example of how elasticity works, but also it will tell you it shows you how products can change based on changing tastes and preferences. So that gives you a good example of how that works. Okay. All right, so I'm going to ask a question and then we'll go back to our good old whiteboard again. But the question that I wanted to ask, or what you're probably asking, is why is this important? How can producers use this information? Well, here's how. Sometimes producers, the government might impose a tax on a certain product. For example, cigarettes. Cigarettes gets taxed, every new tax that comes along just about for cigarettes, because the market can bear it. Cigarette consumers are some of the most inelastic people you will ever meet. They will continue to buy their cigarettes. They don't care about how much it costs. They will just keep doing it. So they're inelastic. It doesn't matter what you raise the price. So it's easy to tax those consumers, and certainly the producers can pass the cost along to them. If a good is elastic and the producers are they have a tax or an extra cost in making the product, they need to know, can they pass that cost along to the consumers? So restaurants, for example, when minimum wage increases, businesses have to know how elastic is the market for restaurant meals, because they need to know, can we pass on this extra tax or this extra cost to the consumer and not lose any customers over it. That's something that the elasticity of whatever you're selling is very important to know, because a lot of your pricing decisions will be based on this. It will affect them. All right, so let's take a look at demand curve. Here we go. Okay, so let's look at your demand curve for this. So the demand curve, there we go. So a demand curve has varying elasticity. All right, so let's take a look at what I mean by that. So you have your demand curve right here. There it is. And it has varying degrees of elasticity. So if you look right here in the middle, there's a point on every demand curve. There's a point where there is unit elasticity. I know, no notable examples, but there's just one point on every demand curve. All right. Up here where the price is high, and sorry, I'm not good at drawing brackets with this type of whiteboard, but up here where the price is high, goods are more elastic. So elastic goods priced up higher. Down here, and remember we said that the lower priced goods are inelastic, so it makes sense that down here, this portion of the demand curve has more inelastic goods. So different portion of the demand curve has different levels of elasticity. Now, producers prefer to price in the elastic portion of their demand curve, but not for the reason you think. Okay, so not for the reason you think, but they do prefer to price in the elastic portion of their demand curve. So I'm going to erase this and show you what I mean and why they do that. All right, so let's start with this demand curve. Start with one right here. There it is. Okay, so there's your demand curve. Now we're going to start with a price up here. And we're going to call that one P1. And there's a price, and we'll draw it down here. There's a quantity, Q1. All right. So you have your price and quantity right there. Now let's say that this producer wants to lower their price. They want to see what would happen if they lower their price. How much money will they make? Will they continue to do so? So let's see. They're going to lower their price down a good amount, down here to P2. And they have a subsequent quantity here, Q2. All right. So now when they lower their price, they're going to have a loss, aren't they? If you look right here, this is what they were selling it for right here. and now they're only getting this much for it. So there's going to be a loss, and their loss is what's inside this box right here. So this shaded area right here, more or less, is their loss. So draw me an arrow. Let's do the text box to make it easier. There we go. So there's their loss right there. Now, but they are going to gain some in customers. They're going to gain some customers. Oops, there we go. They're going to gain some customers right here. So the shaded area of this box, this is going to be their gain. Okay, so you can see there the difference. There's the gain and the loss. Now you can see that the loss is from price going down. The gain is from increased sales. Look, the gain box is bigger. So in this case, you have, in this one, the gain is greater than the loss. So you see that gives them, pricing up here in this portion of their demand curve, the elastic portion, that box is bigger, and it gives them more freedom to change their prices and to attract more customers that way. So they like doing that. Now let's compare over here. Let's see what happens if they price in the inelastic portion of their demand curve. So let's look at a demand curve and let's price. All right, so we're going to put our price down here in the inelastic portion, and we're going to call it P3. And see, there's a price and the quantity, Q3, right here. All right, so let's say they're going to lower their price again. So we're going to make P4 right down here. All right, P4, and we're going to put a quantity 4 that corresponds. There you go. All right, so here, just like before, there's the lower price, so there's their loss. So we're going to shade this in red like we did before. There we go. Now they're going to gain again. Every time they lower the price, they've gained some quantity right here. So let's look right here. All right, and so that is their gain. Now if you look here, you'll see the box with the loss is much, much bigger than the box with the gain. So therefore, we can see that in this case, the loss is greater than the gain for this one. So when they price down here, they don't have the flexibility. They're not going to get more customer. Their customer base is not going to increase from lowering the price. So pretty much stuck with wherever they price. So you can see there that this is another reason why they prefer to price up here in the elastic portion of their demand curve. Pretty neat, isn't it? So it's not exactly the reason why you think. Most people think it's just because they want to be greedy and just get the most money that they can, but that's not it. There's actually a strategy, a pricing strategy involved behind why they make those decisions that they do. All right, so just a couple more things about elasticity and then we'll look at profit. So elasticity affects the slope of the demand curve. All right, so for all you mathletes, you'll know what I mean by the slope, and that will make sense to you. But if a good is more elastic, then they have a flatter demand curve. And it will look something like this. So we're going to put the flatter one right here. You see? Something like that. Right? If a good is inelastic, then they have a steeper demand curve. Right? And it will look, so I'm talking about something like this. All right. So you can see the difference. That one's flattened out and this one's steeper. And it can be different levels of that, but the slope will change based on the elasticity. All right. So now let's see what might cause a good to be more or less elastic. So we'll look at some determinants of elasticity of demand. All right, so some determinants. So the first one is the availability of substitutes. All right, so the availability of substitutes. If there are more substitutes, then a good is more elastic. So because you can change. So you can afford to, if a price goes up for something and there's a substitute readily available, then you can certainly lower your quantity demanded, stop buying it, and go buy something else. So that would affect the elasticity. When there's no substitutes, again, like medicines and necessities, then your goods are going to be less elastic because you have no choice. Also, keep in mind that the word substitute is subjective. What may look like a substitute to some person may walk into the coffee aisle and say, there are tons of substitutes for Starbucks Pike Place coffee. Some people may go to the coffee aisle and say, nope, that's all I want is Starbucks Pike Place coffee. So therefore, there are no substitutes. That's it. So substitutes can be subjective, but we're going to talk more about that when we talk about market structures. And it's a lot of fun, so you guys will like it. Okay, and then the second one is the percent of a consumer's budget. All right, so a larger percent, if a good takes up a larger percent of your budget, it definitely affects your ability to purchase. So if it takes a larger percent of your budget, it affects your ability to purchase, and you may have no choice. You may be forced to be more elastic because it's a large percent of your budget. And those things combine too. If it's a necessity that's still a large percent of your budget, well, I don't know, you may be in the dumpster on that one. But it definitely makes your elasticity stronger or weaker. And then the last one is lag time. And lag time is one that a lot of people don't always consider as much as they should. But sometimes there are substitutes available, but it takes time to find a substitute. So for example, these are things like if the price of gasoline goes up a large amount to where it's costing you a lot to drive. Perhaps you might want to take public transportation, but it might take time for you to find public transportation, or maybe you even have to move. Maybe you say, okay, you know what? I don't want to be at the mercy of the gas pump. I'm going to move somewhere. Well, that's extra lag time, isn't it? Because you have to figure out how to do that, or where you're going to go. If your landlord raises your rent on you, it's not like you can just pack up your bag right away and say, bye, Felicia's, I'm out of here, and immediately go live somewhere else. You would have to wait for your lease to, handle things with your lease. You would have to find a place, and then you'd have to pack up and move and do all those things. And by that point, you may decide, I'd rather pay the extra. But either way, it does take some time to get a substitute. If you're under contract for something, you can't just drop. You have to wait till the contract runs out. So there's some lag time involved. And so this brings us into short long run. What will end up here is that you will be inelastic in the short run and elastic in the long run. Because in the long run, you can make changes. In the short run, you may not have the ability to make changes, therefore you're more inelastic. All righty. So there's that. So now let's talk just a little bit about profit, and then we will call time on this stuff. Okay. So we're going to talk a little bit about profit. Now this is where some of the accounting definitions, accounting terms will be used. But always you can go back and actually the online class, you have better ability to do this. You can go back and check out the definitions when you get to it, when you start to study and when you're taking your notes. Okay, so we were talking about whenever there's a purchase made, whenever each group of the components of demand, they are in this, they are contributing to the economy, and they hope to accomplish something out of it. So we've talked about consumers and what consumers hope to get out of their part of the economy is they get utility. And they don't just want to get utility, they want to maximize it. So as consumers, you want to maximize your utility. You want to get the most bang for your buck. You want to just completely, max out and feel like you've gotten the most for your money and magnify that money. So consumers are maximizing their utility. All right, so you've done that. Producers, on the other hand, producers want to maximize something else. Producers want to maximize their profit. All right, so producers maximize profit. And profit, we abbreviate with the pi symbol there. So I'm going to do it like that right there for you. Okay, so producers maximize profit. Now, when you're looking at profit, to figure out what's the profit, you would have to have total revenue. You'd figure total revenue minus your total costs, and that would equal profit. All right, so your total revenue minus your total cost is going to equal your profit. Now, by costs, one thing that comes to mind is you would look at the actual cash that's paid out for things. So for Georgia Highlands, we pay cash to Supply Technology, we pay cash for buildings and for professor salaries and things like that. Those are your explicit costs in running a business. Right? So explicit costs, these are the actual cash payments or resources. All right, so this is what's paid out in the resource market, your explicit costs. But there's something else that goes along with this too. If you run a business, you want to make sure that your firm's resources are being used to the very best of their ability. You want to make sure that they are producing the most for you that they can produce in that function. And those are called your implicit costs. And your implicit costs, these tie back into making sure that your resources are being utilized to the best of their ability. So what you would ask yourself, what is the opportunity cost of those resources? So the opportunity cost of the firm's own resources, that's your implicit costs. One example for that I can think of is in Coca-Cola. So you may or may not be aware that Pepsi Company owns Frito-Lay snacks, and they also own a lot of restaurant, not Chick-fil-A. Sorry about that, wrong one. I was thinking Kentucky Fried Chicken is one of theirs that they own, along with Pizza Hut and Taco Bell. So Pepsi owns those companies, and so Coca-Cola decided a few years back that they were going to give them a run for their money and get into these businesses. And it was an epic fail. They were not able to do that. They were not very good at it, and they lost money on it. So what Coca-Cola decided as a result is that their resources were best used by just making themselves tops in the beverage industry. And they've done that. They've always just killed it with the sales and had the largest market share of beverages. So the opportunity cost of going into the food industry was way too high. So it didn't make sense for them to do that. So they use their resources for that. Another example you might want to think about is Chick-fil-A. Chick-fil-A makes, some might say, the world's best chicken sandwich, and it's very well liked. They don't make burgers. Now, there's a segment of the population, myself included, that does not enjoy eating chicken. I just don't like it, don't do it. But if they were to start selling burgers, I would come there and eat some. But Chick-fil-A won't do that. One reason why is because they've created this entire marketing campaign with the little cows that everybody loves, saying eat more chicken. If they were to start selling burgers, can you imagine what the PR nightmare that would be? I guess all these cows everybody loves would just be running down the highway, right? Trying to run for their lives. So Chick-fil-A would say that the opportunity cost of including burgers on their menu is way too high. So their resources are best just making the world's best chicken sandwich. All right, so up here, what we had, the profit statement I just made was your accounting profit. So if you want to look at accounting profit is when you take your total revenue minus your explicit costs. That's your accounting profit. But as economists, we of course have to take it deeper than that, and we want to look at something called economic profit. An economic profit, if you were to figure that out, you're going to take your total revenue minus explicit plus implicit. All right, so you're adding them both together. You want to keep in mind your explicit plus your implicit cost. So you want to see if opportunity cost is there. Now, the interesting thing about that is you might think for yourself, well, how can you figure that out? Sometimes you don't know what is your opportunity cost. You don't know your implicit costs. They are implied by the title of the term. And that would be correct. But it is possible to figure that out, and some businesses have done that. For example, Coca-Cola knows how much they spent on that failed venture to go into the food industry, and they can certainly put that on their balance sheet, which they do. So if you were to invest in Coca-Cola, if you were to get their profit and loss statement and look at it, you would see they have a line item for economic profit there. So they know exactly how much that is. And just a word to the wise, if you were looking to invest in a company and you happen to look at their profit and loss statement, and you should if you're planning to invest, and you see economic profit listed out there, then you can know this is a good company, because what they're telling you is our resources are being utilized at their best and most productive level right there. Another company that does that, and they don't have their profit and loss is not public knowledge because they're a privately held company, and that is Chick-fil-A. Again, they also make economic profit, and they list that on their profit and loss statement. So they know how much is their opportunity cost. If you're a small business and you want to figure out your economic profit, maybe you have to guesstimate a little. That's okay. That's all right. You can get that. You can compile data. You can look up numbers. You can see other people who have been in this business. You can also see if you want to start your own business, like the guy with the Run P app that had never done anything like this before. He could compare what would it cost him if he were to work for someone else versus doing this. So you can kind of come up with a reasonable amount for your implicit costs and figure it out from there. But it is important to make sure that your business makes economic profit, to make sure it is at its most profitable. All right, so that's it. That's where we're going to wrap up today. So you have elasticity to think about. You have a lot of information that you can just mull over. Just let it wash over you. Profit, economic profit, accounting profit, your implicit costs, and you can also just kind of think about that concept of opportunity cost as well, because it is important, and we will be coming back to revisit that. So next time, we will get more into costs. We will look at how to graph these costs, some of them, and maybe some economic analysis. We'll start to look at how all these fit together on a graph. And something that's my favorite to talk about is economies and diseconomies of scale. So we'll be looking at that next time. And also, if you want to take a minute to review those accounting terms that I put up there for you, then that would probably make the next lesson go much smoother for you. So take care. I will see you next time, and have a great, good afternoon, good evening, and good night. Thanks a lot.